Government interactions with corporate finance are vast, messy, and continuous. To account for them accurately, we need a highly structured sorting mechanism. Under IAS 20, we filter government interactions. First, we exclude tax-based benefits, like tax holidays. Next, we remove government equity participation and specific industry grants, like IAS 41 agricultural subsidies. What survives are instances where government acts purely as a financier to operations. Establishing this boundary dictates everything that follows. It determines whether a government interaction will actually alter the mathematics of a balance sheet, or if it merely warrants a qualitative footnote in the disclosures. Within that surviving scope, we must pinpoint what qualifies as a government grant. The absolute threshold is the physical transfer of resources from the government to an entity, but that transfer is never free. It must be explicitly tied to past or future compliance with specific conditions relating to the company's operating activities. This strict definition separates grants from the broader category of government assistance. Assistance includes actions designed to provide an economic benefit, but without that direct conditional transfer of measurable resources. General assistance fails the grant threshold because you cannot place a reliable, reasonable value on it. Once an interaction qualifies as a government grant, it is sorted into one of two subcategories. The first is grants related to assets, where the primary condition is that the company must purchase, construct, or acquire long-term capital assets. The second subcategory is grants related to income, serving as a catch-all for any grant not directly related to acquiring a long-term asset. Misclassifying an interaction at this stage changes the entire accounting trajectory. Applying the rules for an asset grant to what is actually general assistance leads to incorrect carrying amounts and misstated depreciation schedules. Receiving cash from the government doesn't mean you can immediately recognize it. IAS 20 demands a strict dual assurance threshold before any numbers are recorded. First, management must have reasonable assurance that the entity will actually comply with the specific conditions attached to the grant. Second, there must be reasonable assurance that the grant will ultimately be received. Until both conditions are met, the grant remains unrecognized, even if the funds are sitting in the company's bank account. This same logic applies to forgivable loans. A government loan is only treated as a grant when there is reasonable assurance the company will meet the specific terms required for forgiveness. This graph shows two loan trajectories, a standard market rate and a below-market government rate. Under IAS 20, the below-market loan is measured at its IFRS 9 fair value. The difference between the cash proceeds and that fair value is the recognized government grant. Enforcing this strict recognition criteria prevents companies from prematurely inflating their asset columns before their operational obligations to the government are securely met. Once a grant clears the recognition threshold, a theoretical debate emerges on where it goes. Proponents of the capital approach argue that grants are financing devices. Because no repayment is expected, they believe the funds should bypass the profit and loss statement entirely and be recognized directly in equity. IAS 20 explicitly rejects the capital approach. The standard dictates that government grants are rarely gratuitous. They are incentives earned through compliance and meeting obligations. Therefore, companies must use the income approach, recognizing the grant in profit or loss on a systematic basis. This relies heavily on the matching principle. The grant must be recognized as income over the exact same periods the company recognizes the related expenses the grant is intended to compensate. The rare exception to this matching rule occurs if a grant is awarded for immediate financial support or as compensation for past losses with no future related costs. In those specific cases, it is recognized in profit or loss immediately. The matching principle is essential here. Recognizing grants strictly on a cash receipts basis violates the core assumption of accrual accounting, distorting the company's actual operational performance for that period. When a grant takes the form of a non-monetary asset, like a parcel of land, it is standard practice to assess the fair value of that asset and account for both the grant and the asset at that fair value. Looking at these two side-by-side statements of financial position, we see the binary choices IAS 20 offers. Under the first method, the company sets up the grant as a separate deferred income liability, leaving the asset at its full gross carrying amount. That deferred income is then systematically amortized into the profit or loss statement over the useful life of the asset. The alternative method deducts the grant directly from the asset's initial carrying amount, leaving a smaller net asset value. This indirectly recognizes the grant in profit or loss through a systematically reduced depreciation expense over the asset's life. Grants related to income offer a parallel set of presentation choices for the profit and loss statement. Present the income grant gross, as a separate line item, or under other income. Alternatively, they can present it net, directly deducting the grant from the related expense line item. The argument for the net method is that the specific expense likely wouldn't have been incurred by the entity if the grant hadn't been available. Therefore, showing the gross expense without offsetting the grant could mislead investors about the company's baseline operating costs. These dualities mean that two companies experiencing identical economic realities can produce completely differently structured financial statements. Understanding their true positions requires deep analysis of the accounting policies in the footnotes. If a company fails to meet the compliance conditions of a grant, the financial benefit is stripped away, and the grant becomes repayable. Under IAS 8, this repayment is accounted for strictly as a change in an accounting estimate. It is handled prospectively in the current period, rather than by restating prior period errors. If a company deducted the asset-related grant from its carrying amount, repayment immediately increases that carrying amount by the repayable volume. To fix the resulting chronological gap, the cumulative additional depreciation that would have been recognized must be calculated and recognized immediately in profit or loss. A grant repayment forces a sudden correction to the current period's financial statements. Because the asset's carrying amount rises abruptly, management must immediately test the new balance for potential impairment. We must also close the loop on government assistance, specifically those benefits that cannot reasonably have a financial value assigned to them. This includes qualitative support like free technical or marketing advice, or the provision of specialized government guarantees. It also includes transactions that cannot be separated from normal operations. A government procurement policy that guarantees a certain portion of a company's sales provides an unquestionable benefit, but isolating that value from normal trading is entirely arbitrary. Conversely, general infrastructure improvements, like building a new local highway or water system available to the entire community, are permanently excluded from even the definition of assistance. To maintain transparency, IAS 20 requires specific disclosures. Entities must detail their adopted accounting policies, their presentation methods, and the exact nature and extent of the grants recognized in their statements. First-time adopters of the standard are required to adjust their financial statements, either by a complete change in accounting policy under IAS 8 or by applying the standard prospectively to new grants. Financial transparency under IAS 20 requires reconciling the figures on the primary statements with the unfulfilled conditions and qualitative assistance described in the footnotes.